This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning John Rubino, well-known author and publisher of the website DollarCollapse.com. Good morning, John. Welcome back.
Morning, Gord.
John, we were talking earlier this week regarding unsound money, and we mentioned we were going to be back and we're going to talk about the potential of what's happening with velocity of money and the crack-up boom. And this is really leads into what we were talking about. You brought some great charts, and I thought we just, to make sure we have time, we'd start right off with the one here on velocity of money. And this is springing, for our listeners, this is springing from an article that John wrote and published on his site called Velocity of Money and the Crack-Up Boom as a follow-up to it if you want to listen to it in full. But anyway, John, we have a velocity of money chart.
Yeah, Gord, the concept of the crack-up boom comes from Austrian economics, and it is a period when, after a long time of gradually increasing inflation, people finally figure out that their currency is systematically being destroyed, and they just give up on it. They start converting paper currency as soon as they get it, or electronic currency, into real stuff. And so that's when you have your hyperinflation at the end of a long period of increasing inflation, and you have your currency collapse. And based on the chart here of money velocity, we are a long way from that happening, because money velocity measures the number of times that a given piece of currency turns over in a given period of time. And lately it has plunged. So it's doing the opposite of what you would see in a crack-up boom. And the reason for that is that in 2009, the global financial system had a near-death experience. The big banks basically were almost destroyed. They almost evaporated. And the bankers remember that. They have been terrified of starting new lending programs for the last few years. And so the money that they take in via deposits or as bailouts from the federal government or whatever, they're just keeping on their books. They're buying treasury bonds with it, and they're not lending it out. And so that's why the economy hasn't grown as quickly as you would normally expect, with interest rates at zero and the Fed creating all kinds of new currency. Instead, you've just seen excess reserves at banks soaring. And, we've gone from virtually zero, which means the banks were lending out pretty much everything they could, to almost $2 trillion in just the space of a few years. Now, this is money that banks are sitting on, that they could lend out, but they haven't felt like doing it lately, because the world has seemed too threatening and stressful for them. They'd much rather just sit on the money and collect a little bit of interest from their treasuries.
Well, they were being paid by the Federal Reserve for these reserves too, which they hadn't been before.
Yeah, it's free money.
So it was really very attractive. So they were battening down the hatches, is what they're effectively doing. Now the Fed is saying, well, we're thinking of taking the interest off that money, and things have also changed in that storm out there. They're not quite as bad as it was in Europe, and things have changing.
Yeah, in the last few months, the economy in the U.S. especially has changed dramatically. You've seen stocks go through the roof. We're now at record levels again on the S&P 500 and the Dow Jones Industrials, and you've seen home prices pick back up again to where in some hot markets, prices are higher than they were at the peak of the bubble in 2007. And so from a banker's standpoint, let's say you're running a bank out there. You've been sitting on all these extra reserves, all this cash that you could have lent out, and you didn't. But now, all of a sudden, you're seeing your potential customer base get a lot more creditworthy. Their stock portfolios are going up, and their home prices are going up, which means the collateral for a mortgage is now a lot more legitimate than it used to be. And so you're seeing your competitors begin to lend money into these markets. And you're beginning to worry that if you don't do it, Their competitors are going to be collecting all these fees and making higher interest rates on their assets now, and they're going to look better than you.
This is exactly what the Fed has been working and is trying to do, is to force these banks or incent these banks or create the environment, which is now arriving, where these banks are going to start to take this money and apply it. Now the question, John, is in what way?
Yeah, well, and on what scale? Because this went on a lot longer than Keynesian economic theory would say that it should. And so in that time, the Fed has been just shoveling money into the banks. And so now you've got, $2 trillion worth of reserves in a fractional reserve banking system where a bank can lend out 5 or 10 times its reserves. We're talking an amount of potential lending just from the banks via their reserves that dwarfs the size of the entire U.S. economy. So, potentially there's a huge amount of money waiting to just slam into this economy. And you're starting to see it, for instance, in the stock market, where margin debt, which is money that people are borrowing against their stock portfolios to buy more stocks, is at record levels. And so this is a level of leverage in the system that is already at a record level. And that's part of why the stock market has gone up so dramatically. But this is a drop in the bucket compared to what could be flowing into the system if banks begin to commit their reserves to home loans and car loans and business loans and more margin loans.
See, this is, John, to me, when I look at this margin chart, as a contrarian, it always says to me it's at a peak and it's going to come off. And we will. We'll probably have an intermediate kind of correction in here and a scare, especially as I see that 10-year moving up to 2.26%. However, what to me it's really saying, a lot of people are seeing enough of a strength in the economy, whether you believe it's there or real or not, that the asset values are such that money from the banks is going to start to move, and only a small percentage can make it dramatic. So they're trying to front end this thing, and they've been end running the Fed for quite a while. Now they're going to try and front end the banks here, to me is what these charts are saying. Now, how it's going to happen is a complex discussion.
Well, now, bankers, we have to understand, are herd animals, just like any other humans. And
Precisely.
So they tend to pile into markets at exactly the wrong time. You look at the history of the real estate market in the U.S., you see massive amounts of new lending on buildings or commercial buildings and houses just as the market peaks, because bankers, they hold off and they hold off and they hold off, and finally they can't stand it anymore. They see the more aggressive competitors doing better than them. And at the end, you see everybody pile in just in time for the market to collapse. And so what we're seeing right now is an exaggerated version of that, because the Fed has pumped so much money into the banking system that hasn't been committed, that there's a real possibility of bankers just panicking now and us having a melt up in bank lending. And if that were to happen, the numbers are so huge that the question becomes, what does that do to the economy if you get $15 trillion of newly available money from the banks out there, chasing markets that are already at record levels? What does that do to the real estate market in Southern California if, starting from a record home price level, all of a sudden you get liar loans coming back and interest-only mortgages coming back into style? And what does that do to the stock market if banks are willing to lend beyond the record level of margin debt and just keep it going? Do we get the crack up boom, to come back to the original point of our talk? Do we get a point where asset prices are rising so dramatically that people figure out, or they generalize from stock and real estate prices going up, they generalize to the rest of the economy and come to the conclusion that the currency is what's going down rather than these other markets going up, and they just don't want to hold dollars anymore. So, like you said, we could have a serious scare when interest rates spike in the short run here, which could kind of delay this process for a while. But we really have created the conditions in which something like this is finally possible.
I really agree with your observations in that when you get an explosion upward, a crack up boom in pure Austrian sense or hyperinflation, it's because it's a currency event. It's first and foremost a currency event. That is, people lose confidence in the currency. And it's not just that prices are going up, which we are well aware of, and we talked about it earlier this week, but there's a flight to protect the value of your store of money. Now, in the Weimar, it became all your goods and services and everything went up. I think this time it's going to be and is already unfolding in a different manner. I don't like the word crack up boom. I believe what it is going to be, and I refer to it as the Great Rotation. And it's going to be, in my mind, is going to be a 3-stage kind of evolution. And we're currently in the first stage of that, which is the equity bubble. And, on a backdrop, John, we're moving from the fear trade. And we've been in that a protracted period of time because, we had the irrational exuberance, the dot-com bubble in 2000. And then we had protracted low rates, which created the housing bubble through 2007, which scared people. So everybody got into this mentality. It's a return of capital versus a return on capital, which created the bond bubble. So now through regulatory arbitrage and financial repression, we got a group that have been willing to live with zero rates or low or negative real rates, but they can't survive any longer. I mean, you can't run pension plans. You can't and run money managers if you're not making some kind of decent yield. They're out of time. And same with the banks with all of this money. So they're saying, where can I go? And now they're starting to say, I'm looking at dividends. I'm looking at equities. I know they're inflated. I know they're disconnected, and they are. They're so distorted, but I almost have no choices because I'm paid to keep money invested. And John, it's flowing. And where it's flowing, it's going in and buying outside of the United States real assets because the rest of the stock markets aren't where the United States stock market is. Global markets are down. The commodity-based countries, the emerging markets, are having serious impacts, which means they're on sale. And when stock is your currency for trade as a corporation, what a better time. And that's the beginnings of this. You call it a crack up boom, but it's an asset bubble and moving it into real assets. And I think that's what the banks are smelling that because the charts we were looking at before were U.S. charts. You look at them on a global basis, and remember, they're all competing. It's a global trade that's starting to unfold. Am I making sense there, John?
Oh, absolutely. Another way of putting what you're saying is that the U.S. is exporting its own inflation. We're creating huge amounts of new currency here, a lot of which is flowing into other countries and bidding up the value of their assets.
It has to happen this way too, John, because unless it happens, we're going to have pension plans totally implode very soon, especially in the United States with 75 million baby boomers retiring and looking for pensions. The magnitude of unfunded liability pensions right now, that unless they get some significant increases somewhere, and probably because they're moving more to equities, we're going to have a bust. So the Fed and the central banks know that they have got to create this rotation. The trick is going to be, how do they hold investment also in the bonds at the same time? And that's what we're seeing in Japan, where all of a sudden the JGBs are shooting up, and they will force them down, the same as we will have to force that 10-year Treasury bond. So there's going to be quite a bit of games going on. From gold, they're going to hit gold again, in my mind, before it slowly and steadily rises with these increase in balance sheets.
And it comes down to their ability to control this whole process, which I'm not convinced of yet. There is a lot of opinion out there that this is planned by brilliant people, and there's a progression, and it sure does look like that. But there are so many moving parts here that it's like a pressure cooker where you tamp down on one part of the global financial system, but the pressure has to be released somewhere else, and it all comes back to currencies. Yeah, you can depress the yields in the bond market, and you can pump up returns in the stock market and the real estate markets. But that creates pressure that has to be released somewhere else. And I think currencies are where it is released. The value of paper currency is going down while all these other things are going up. And what happens when people see that? That's the crack up boom. If the global financial system figures out that it's public policy of all the powerful institutions out there to make asset prices go up by throwing newly created currency at them, how do you keep your currency values up? You can't, it seems to me, because in effect, what you're doing is making currencies go down in price versus all the real assets out there and the financial assets if we're talking about stocks and bonds. And, the kind of instability that creates, to me, seems essentially uncontrollable. Like they're creating this monster, this nonlinear system in Jim Rickards' terms that at some point will be completely uncontrollable. And so the question is, how long can they keep this going? How far into the Great Rotation can they take things before they fall off the tiger, let go of its tail, and it eats them? And I think that's anybody's guess at this point.
Well, as Catherine Austin Fitz says, it always takes longer, and she calls it a slow burn. And there's games that they can drag out. Right now, John, I believe they don't have the control that everybody thinks, but right now the currency cartel, as I refer to it, that is the four major currencies that control 90% of the trading, allows this game to go on, because if one currency goes down, another's got to go up. But if you got nowhere to go, and you're buying all your goods in either sterling, the yen, the dollar, or the euro, you can get away with this game, and you can drag it on, and that's until there's an alternative, and there will be alternatives. And you and I have had discussions on those alternatives stemming from who's buying the gold. But I think what's going to, John, this sequence of this asset bubble that's coming, and it's significant, is going to probably be triggered because they're going to have to push a significant more money into the system. And I believe that we're being set up for this overt permanent money financing, OPMF, which is nothing more than complete monetization of the deficits. Clearly, Europe is in serious situation. Austerity's dead. They're going to have to do that. We've got a budget, another debt ceiling debate coming here pretty soon. So I'm guessing that my feeling is August, September, we'll start to do that. And that's when you're really going to see the scare be over in the markets that I'm anticipating. And then this real movement of the capital you identified in the reserves starting to flow across into assets, and in a significant and accelerated rate. But as you also point out, this is not as controlled as some might imagine. And at some point, it's what we're creating is oscillating waves of instability that are getting larger. We saw that in Japan. Look at the dramatic movements in the bonds, JGBs, how many times they had to stop trading. That's indicative of what we're going to see pretty soon on a global basis. Pretty soon, probably not into 2014, but it's coming. And when that happens, it cracks. And a crack up boom will do exactly that, crack.
Yeah, so Gordon, is this the final bubble, what we're blowing up right now? Because as you said, oscillating. No, so this is not the final bubble?
No,
yeah.
But it's part of the expanding one, in my opinion. And it goes through three stages as it blows up. There's an absolute chase into getting into any kind of asset, because to me, John, real wealth is not something you can find to store anymore. Yes, you can do it in gold and silver, but it doesn't make you any money. It just preserves your asset. The real wealth today is in something that generates a discounted free cash flow, and it's unencumbered. And that's what they're chasing when they're chasing assets. They don't even mind paying up. Look at what Buffett paid when he bought Heinz, and everybody said he overpaid. What he was after was that free discounted cash flow, because he just saying, I don't care about the currency, because I know where the real wealth is. He's the ultimate in the indirect exchange, and he's playing that kind of game. And that's what they're chasing right now. That's what they're looking at.
But the sustainability of this it seems like it's very limited.
Oh, it is. Yeah, I agree.
Yeah. It seems so hard to believe that people aren't going to figure this out.
It's like a musical game of musical chairs, and we just keep pulling away chairs in each chair, but we keep the players in the room. And now all of a sudden we got all the chairs, all the players, and there's only one chair left. Mm-hmm. And we're all going to jump on it, and that's right now it's going to be assets, but we all know it'll just crush the chair. I mean, we've created an instability that can only end one way, and it's, as Jimmy Rogers said, not well.
But as you said, timing is everything in this.
That is the key right now. There's going to be fortunes made and lost in what I'll call these gyrations of instability. And markets are going to become, and there's going to be a fear. You're going to be afraid not to be in, as much as you're afraid right now to be in. And so how do you judge that?
that's the dynamic for the bankers now. They're feeling it already. They're seeing themselves miss this boat by not lending into this market, or not having lent into this market 6 months ago in anticipation of these asset prices going up. So they're going to be really prone or really vulnerable to the blandishments of lending into this market pretty soon. Maybe, like you said, we get a scare, crack in the stock market, spike in bond prices in the short run, and then the government comes out with an even bigger QE plan or total debt monetization or whatever, something that they've crafted with the idea of getting the markets back going again. And at that point, the floodgates open.
Yeah, what the banks and what they're all gearing up for, in my mind, and if I was a banker, is they're trying to figure out how to do a global debt for equity swap, and to figure out a way to move as much debt as they can from something that is exposed and move it into something that's real. And I define what real wealth is, but equity. And that's always been the case as we go through boom and bust cycles. Look at the Depression here in the United States. The banks foreclosed and took all the farms, right? And the farmers were out and trundling across to California looking for work. But the banks, as we go into the cycle, always seize the assets, because it's the assets that it's the collateral where the real wealth is. And right now, John, one of the issues, and I think we talked about this, is the reason the banks can't lend right now is they can't find good assets that are out there that they can secure against. And to secure, you need collateral. And all the collateral is encumbered right now, or over-encumbered, or over-leveraged. Or you take unsecured and you need free cash flow, and they can't find cash flows that they believe are sustainable. That's what's holding them back. But there's an answer to this. And the answer that they're now seeing, as we're seeing with this explosion in private equities, is in fact in the global markets that are being crushed, where you can get at some of these assets. And so corporations which have no sovereign borders are going to be on a shopping spree, and they're going to be out acquiring. It doesn't mean that the S&P itself will be going through the roof. Be careful with that. But the other exchanges will pick up, who are being crushed right now in reverse, in my mind.
Now, Gord, does this go back to the corruption of society via fiat currency that we talked about in our last session? Is this one big global scam in which the main reserve currency countries are artificially depressing the price of resources around the world right now in order to use paper to buy them all up, with the idea of then, letting them revalue later, but having the free cash flow that you talked about?
Yes.
Okay, so this is an extreme version of the fraud that we talked about last time, because we're talking multiple trillions of dollars of assets changing hands.
I don't think they would use the word fraud, John. They would just call good business.
But we've got governments manipulating the process, artificially.
But governments always manipulate. Governments have always been in the exchange and trying to protect currencies. Governments would say they're trying to protect the standard of living and their citizens' pensions. No matter how they look at it, any country would argue that it's in their citizens' best interest. And also, remember, countries have always been at war. And we have a different type of war that's being fought today. And make no doubt about it, we're in the middle of economic warfare.
But to somebody in Brazil or possibly China, calling it by various names doesn't change the fact that you've got a big, powerful issuer of a reserve currency using that currency to artificially depress your assets and then come in and buy up your assets.
Exactly.
We can call it fraud or we can call it war. It's still an act of aggression.
That's why you're going to see, in my mind, well, first of all, you're seeing them in their reserve buying gold. All those countries you mentioned are buying gold faster than we've ever seen happen before. But at the same time, you're going to see capital controls implemented, and so that the hot money can't get at these assets. The same as the United States, for national security reasons, has limited takeovers of certain industries. You're going to see them very quickly start to react that way. And then they're going to call them forms of trade wars, because, the currency wars were always trade wars. This time it's not going to be a trade war. It's going to be asset wars.
Well, now, but is that the limiting factor then in this debt for equity swap? Because if China and India and Brazil and Russia say, we don't want to play anymore. We now own enough gold to back our currencies with gold. And now all of a sudden our currencies are a lot more useful as reserves and as trading vehicles than the dollar and the euro and the yen. And you guys can just go play your own game somewhere else. And wouldn't that stop us cold if they did that?
In theory, but in the game is subtle. There's a balance. There's a trade. There's all of the politics that goes on behind it. But what will happen is we will have volatility. We'll have instability. We will be in a continuous state of crisis and fear. And then it'll be disrupted with cyber attacks.
Yeah, see, that's kind of what I'm getting at with this, with the idea that this is uncontrollable at some point. We just talked about so many different moving parts and
Correct.
So many different personal decisions. What the Chinese premier does is not something that can be predicted with physics.
This is also unpredictable, John.
Yes, yeah.
Best you can do is to identify the very, very many moving parts in this. And then from an investment standpoint, try and figure out just a long-term, high probability move for your own protection.
But if the probability of any one outcome, because of the number of moving parts and the amount of instability that all those moving parts are creating, if the probability of any one outcome drops to some level that's below what you would normally want to bet on, then what do you do? Is the only thing that's left for us to just bet on volatility from here on out? Assume it's going to be volatile, buy VXX, and just and ride those waves.
The traders will.
Yeah.
What you can bet on is you're going to have significant crises continuously, and crises create dramatic distortions in financial markets.
But would we buy Brazilian stocks if Brazil is going to impose capital controls at some point? And that's going to cause instability? Or would we buy Japanese bonds or Japanese stocks? It doesn't seem like there's an asset class out there that is, forget about risk-free. There's no asset class out there that's not terrifyingly dangerous in this kind of an environment. What's left? Even gold, which used to be the safe haven and the thing that you hid in during times of crisis, that's now a target of government manipulations because they can't let it go up because it screws up so many of the other moving parts that they're trying to maintain. So, really, what do you do? Where do you hide out in this kind of a market?
For those who figure this out, they're going to be insanely rich, John. And I personally spend a lot of time sorting through the mechanics personally, but I know this. It comes down to where is real wealth and real value. And as long as you buy and own real wealth and real value, no matter what happens at the end of the day, it should be the same. And you should be better off then. So the question you have to ask yourself and answer is what do you believe is real wealth and real value? Mm-hmm. And in value, I define that as who is going to return to you on any given day a profit denominated in a currency that's growing. What I refer to as free, discounted, unencumbered cash flow.
Totally agree. But the end game for a crack up boom, assuming that we have something that follows the Austrian script, which we might not because the world is so different than when those theories were being formulated. The end game of crack up boom is a deflationary crash. When governments completely lose control of all these processes. And that's bad for real assets. Your free cash flow dries up in a situation like that.
Exactly. That's why the end of the game, and I've said the 3 rotation, the end of the game is Mr. Global, if you would. He's going to be in gold. He will have the ultimate store of value and will have it all.
Yeah, I agree. That makes complete sense as an end game.
But we got a lot of gyrations between now and then. And people are going to lose big time in gold on a number of occasions.
And it's also assuming that they can achieve their end game. If we're talking Western central banks and developed country corporations that are Mr. Global, they've got some pretty formidable opponents now in China and Brazil and Russia because those guys own lots of natural resources and they're buying up huge amounts of gold. So what if Mr. Global loses to China and Russia and Brazil at some point, at least in a monetary sense, when Mr. Global no longer has the world's reserve currencies to play these games with?
Nobody can.
I know.
Exactly, John. Nobody. It's like wars. The battles have to be fought before you know who's going to win the wars.
Yeah.
And all we're getting a glimpse of is the battles that are being set to play out.
And to me, this is one of those scenarios where the more you think about it, the less certain you become. You know, it's not. It seems very simple on the surface, and then as you add moving parts to the machine, it gets more and more complicated, and it stops being clear whether the machine keeps running or whether this last part you added causes it to spin out of control and collapse in the near term. And I just don't have a sense for how this all plays out, except that it's going to be crazy, right, Gordon? We're going to look back 50 years from now at the coming 10 years and say, oh my God, I can't believe that happened. But it's not clear what we're going to be shocked by, because we can't tell what's going to happen exactly.
Great discussion, John. I really hope we didn't confuse our listeners here today, but I think the answer is it is a very confusing time. May you live in interesting times. We have it. But fortunes will be made, fortunes will be lost for those who can stay with it and have a framework and identify as things are changing. And they're going to change rapidly. But if you know which legs you're on as you go up and down in these ever-expanding acceleration of instability, before it breaks and snaps, you should be able to protect yourself. If you stay with what you believe to be real wealth and real value. Any closing comments, John?
No, I think we went long enough this time, but again, this is a subject for a book, not for a half-hour conversation, because the world really has changed. And stuff that's going on now would have been inconceivable 20 years ago, and it's business as usual.
We'll talk again next month.
Great. Look forward to it, Gord.
Talk to you, John. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.